Anybody who's ever worked with small and medium-sized businesses that in particular need to raise capital. This doesn't really fit those who don't need to raise capital, but for those that do, the universal problem that all these companies encounter is the enormous difficulty in raising such funds. And if you examine the underlying causes of that, I mean, why is it so hard, for people to go out and raise money for a small business? The key comes down to a term they call liquidity. And that is, this is an issue from the investor standpoint. And that is that, the way of sort of paraphrasing it is, this would be a question that I might ask as an investor is, if I put my money into your company, how am I going to get it out? That's what they mean by liquidity. It's a term that applies to the readiness with which I can take an asset and convert it into ready cash. Now, anybody who's bought stock, for example, on the stock market, that's a condition they refer to as liquid, that I can contact my broker or use E-Trade or whatever at any point I want to, and I'm sitting here holding a bunch of stock, I want to get rid of it, I can do so in a matter of minutes. Whereas if I invest into your company and it's a private company, by law, that the federal government, through the Securities and Exchange Commission and their laws, as well as the laws of each and every one of the 50 states, that I am restricted in being able to sell that stock to anybody at any time that I want, unless that stock has been approved in a various variety of ways, without trying to explain what that is, that the most common form of investment is in what is called restricted stock. And by very definition, that means I'm not freely allowed to go and sell it again. So if I put my money in your business, how can I get it out? That's the big question. And what this whole system is all about is addressing that very problem. Well, in order to explain the concept, let me tell you about how the idea was even first born. Several years ago, I attended a conference down in Southern California that was all about economic development, and that some pretty heavyweight, folks were there. In particular, the chief executive officer and the chief investment officer for the two largest pension funds in California, the California's employees retirement system called CalPERS, and the Teachers Association. We're talking about the biggest one, has over $200 billion worth of assets that it invests for its pensioners, its retirees. And there was a panel discussion where the two CEOs and the two CIOs were talking, and the fellow from CalPERS, the CIO from CalPERS, happened to talk about a problem that they as a pension organization had, and that this was a universal problem. All pensioner type organizations had this, and that was that in certain types of investments they do, they provide funds to organizations like venture capitalists. So they're the sort of like silent partners behind a venture capital firm that in turn takes their money and they go and invest it in a variety of companies. Well, in every venture capital portfolio, as they would call it, of investments, that a certain percentage of them will never break out of this liquidity problem that I was talking about before. The goal of a venture capital firm is to take that money, put it into companies, and at some point get what they call an exit, where they're able to convert the investment into selling it off, either through the company gets bought by somebody else, or they go public and the stock that was originally purchased by the venture capital company now is freely tradable on the marketplace, like I was talking about before, about being able to easily buy and sell shares on the market. So those liquidity events represent the way that the venture capital company gets their money back. Well, out of every, say, 10 companies that they invest in, they only have a limited number, maybe 2 or 3, that they're able to get that liquidity event for. At the other end of the spectrum, they've got companies that died entirely, so that they lost all their money. But then there's a group in the middle that they've invested in, they had big hopes for it first, but then they get to the point where they discover, no, nobody wants to buy this company, and it's not going to be big enough that it's going to go public, etc. And they have stranded investments, in those, that what I tend to call a frozen investment. And this was the problem that CIO from CalPERS was talking about, where he said that we get money tied up in there, and as a pension fund, our ultimate goal is to be able to get a return on the investment we do for our pensioners, pull that out so we can distribute it. Well, those kinds of investments are ones we never can recover, because of this, the illiquid characteristic. So at the end of that particular panel discussion, having just come off of putting together a particular project in association with several businesses that I had been working on, I had an idea that struck me as he was talking, and so at the question and answer point, that I stood up and I said, well, I've had an experience with dealing with that kind of an issue here recently, and I took several companies and I put them together under one common holding company, and we were preparing to take that public. Why don't you take a number of these companies that are invested in by these venture capital firms and combine them under one holding company and take that public, and now everybody's able to achieve liquidity in the process. And he looked at me and said, that's a really good idea. And so it was just a spontaneous idea that I threw out off the top of my head based on some personal experiences I had. But I chatted with him briefly afterwards, and that kind of got the idea rolling around in the back of my head. And so I kept chewing on that idea over a period of time, and quickly came to realize that this problem of liquidity was not unique to pension funds and venture capital firms, but in fact is the universal problem. That many small companies are started where they go out and they'll sell stock to their family and friends as well as themselves and so on, and all of them wind up in this same problem. They have no way to get their investment back. All kinds of other investment structures, or say what they call angel investors. These are individuals who go and invest money into different companies. That's a universal problem for them. Various funds that do it, like venture capital funds, but there's a whole group called private equity funds. They all have this problem. So this was a very universal problem out there, and that I started applying this generic idea that I presented to the chief investment officer for CalPERS, and thought, we could take that same idea and really apply it just about anywhere. So the fundamental idea here is that if you can take a group of small companies, small and medium-sized companies, that in and of themselves are not good candidates to either be bought by somebody else or to go public on their own, because especially here in the United States, it is a very difficult idea, and expensive idea and so on, to go public, even in the lowest level of the market. Even if I'm not doing what they call an IPO, so we're trying to sell a bunch of stock to everybody, but just simply want to list on an exchange, get our shares freely tradable up there on things like they call it the pink sheets, or the over-the-counter bulletin board that's a junior part of NASDAQ, etc. That if we wanted to do that, there's a lot of work, expense, and effort to going and bring that about. If we were to instead take a number of smaller companies and bring them together under one common company, and this is what a holding company is, by the way. A holding company is a corporation that's set up to own other things, and the things could be real estate, they could be banks, there's bank holding companies, it could be all kinds of other assets, but one of the most common is owning in part or in whole other corporations. So that was